What's going on, everyone? It's Griffin here, and in today's video we're going to be speaking about real estate, and more specifically, what are some things that I've learned over the past 2 years of being a real estate investor and landlord in my early 20s. This is a video that I honestly wish I would have had before starting to invest in real estate myself, because typically on YouTube and even in my own content, real estate focused videos are tailored around analyzing properties and deals, going through the numbers, and so forth. But it's not too often that we speak about qualitative elements, right? Things such as tenant interactions, best management practices, things to keep you organized, and a whole bunch of other things that, even though they might sound somewhat boring, can ultimately make or break your property business. I pretty much just jumped headfirst into property investing without really thinking twice about it, and so naturally I've made a whole bunch of mistakes along the way, which is totally fine because ultimately I gained quite a bit of experience and knowledge around these things. But hopefully today's video can help shed some light on what those mistakes were so that you can avoid them and start one step ahead of me when you go to buy your first rental property or even your first home for that matter. Now, one thing I want to make it really clear right out of the gate here is that in my own experience, property investing has been a fantastic vehicle for building wealth. I don't really care if anyone says otherwise on the internet. These people have maybe not invested in real estate themselves or aren't actually property owners. Yes, this is definitely a lot more involved than stock market investing, but in my opinion, the pros severely outweigh the cons. I have no reason to continue investing in real estate and speaking about it on my channel if it wasn't something that I did myself and thought it was of value to myself and to the audience. So anyways, with that said, yes, real estate, in my opinion, should be an asset class that pretty much everyone tries to include in their portfolio at one moment or another. This is something I've mentioned countless times on the channel, but I do realize that this is easier said than done. As opposed to investing in the stock market, investing in real estate does definitely have a higher barrier to entry. You need the capital to start investing, you need recurring income to show the bank or other lenders so that you can get approved for a mortgage, and a whole bunch of other things. So in an effort to make real estate investing more accessible to absolutely everyone, I recently reached out to a Canadian company called Addy, which is a platform that completely eliminates the barrier to entry for real estate investing and allows everyday investors such as you and I to invest in specific properties that Addy acquires and then splits up into purchasable shares within their platform. Unlike with the real estate investment trust, where you're investing into a trust that holds dozens or even hundreds of properties that you really have no information on, well, Addy allows you to specifically invest into the properties that interest you based on your goals. The way it works is that Addy identifies investment properties with a specific strategy in mind and then releases it on their platform, allowing its members to become part owners of the property up to a maximum $1,500 investment per property. For example, just this past week, they released this RV and campground property for a value add opportunity where they're expecting a 30.9% estimated internal rate of return or an estimated 66.8% return on investment. And what's really awesome about Addy is that there are no management fees that are charged on your invested capital. Instead, you pay $25 per year and then you have access to Addy's platform where you can freely invest into any of the properties that you choose. This way, you can be sure as the investor that 100% of your money goes directly into your investment. So if this is something that interests you as an alternative to physical real estate investing, then make sure to check out Addy today using the first link down in the description to start adding property to your portfolio. Alright, so with that said, let's get back to things that I learned as a property owner over the past 2 years. And in no particular order here, probably the most obvious one is the fact that as a 22-year-old when I started investing in real estate, I've been younger than basically all of my tenants this entire time. And at the beginning, that was definitely strange, I'll be honest. I mean, truly, this was never really a problem or anything, and for all they knew, maybe I was 30 years old with a baby face, but I think that for a lot of newer investors, it can already be intimidating in and itself in your own mind to start purchasing property and dealing with tenants in the first place, and especially if you're a younger person like me, this can definitely play in your overall confidence at the beginning. Now, I've read some forums and posts where some people say that they've introduced themselves to their tenants at the beginning as property managers, and this is is just something that I would not recommend whatsoever. First of all, you're lying to people directly in their face. And second of all, it's pretty much inevitable that you're going to trip up in this lie at some point or another for a multitude of different reasons. First of all, you're going to be talking to them on a pretty regular basis, most likely. And then also your name is going to be on the lease anyways. So that's just going to be really strange. And basically your tenants aren't going to trust you as soon as they figure this out. So no, that's definitely not something that I would recommend. I would sooner just recommend being really upfront with your tenant. When you first acquire the property, go meet them directly, introduce yourself, and just come with an air of confidence here and set a precedent for how things are going to be running under the new management, which is you. You can have your own set of building rules and your own way of managing your business. At the end of the day, everyone who starts out in real estate has pretty much no idea what they're doing. And this is completely normal. I've been in that same situation. But if you just pretend like you know what you're doing and start gaining experience, eventually you'll end up being a lot more confident with the way that you manage your properties. And this actually leads me into the second point, which is that I cannot recommend more keeping your communication with your tenant over email as much as possible. This is something that's extremely difficult to do if you don't implement it from the get-go. And I made the mistake of not doing so, but trust me, this is going to save you a lot of headaches from a personal interaction standpoint. First of all, emails are a lot more formal than a text message. So instead of just sending out a text message to you in 5 seconds, if a tenant wants to get in contact with you, typically when they're going to send an email, they'll have to spend a little bit more time thinking through preparing the email and sending it over to you, which ultimately is going to be beneficial as the landlord. I would actually even recommend creating your own separate email for your property business, and this is going to be the exclusive email where you're communicating with tenants, and actually you're also going to be collecting your payment through that email address. Take this advice or leave it, but trust me, once you start scaling out your business to 5, 6, 10 doors, you do not want to be dealing with 5 to 10 tenants over text multiple times a month on your personal phone. Now, of course, they'll still have your phone number in case of an emergency that needs immediate attention.
You texted me, 911, call me,
Yes.
all in caps. Do you know what 911 means?
But 95% of the time, an email will do, and this sets professional boundaries. In my personal experience of texting with tenants, which I have done countless times, and I'm telling you, it was a mistake here, this lowers the overall bar of professionalism, and tenants can maybe start seeing you more as a peer rather than a landlord, and that's the last thing that you want, but more on that later. All right, the next recommendation, which goes hand in hand with the last one, is to try and get all of your tenants to pay you through e-transfer exclusively through that email address that you created in the last recommendation. Now, most people in this day and age are quite familiar with this type of payment, so this shouldn't really be a problem, but I would avoid collecting cash and checks as much as possible. This pretty much just makes things a little bit more complex from an accounting standpoint, and then also from a monthly money management standpoint. So if all of your tenants are paying you through that email that you created, well, first of all, it's a lot easier to track all of your payments at year end, and then also this is going to save you a bunch of time. As a real estate investor, you will quickly realize that the last thing that you want to do is waste your time unnecessarily going to the property if you don't have to. And this accounts for going to collect payments as well, and then also having to wait in line to deposit your cash or depositing your checks, which ultimately could actually bounce depending on the type of tenant that you have. So yeah, this has been a lifesaver for me. I couldn't recommend it more. And initially, some of my tenants want to pay cash, and now everyone is paying through e-transfer. It is just a no-brainer. Moving on to the next tip here that is absolutely critical is to have a separate bank account for your property business, even if you only have one property to start with. You should avoid mixing your personal bank account with your property investing at all costs. This is just going to be a disaster from an accounting standpoint at the end of the year, and keeping track of which payments were personal and which payments were for your property business. Now, luckily, if your mortgage is with a different institution than where you do your personal banking, typically they're also going to open up a bank account for you in parallel to your mortgage. But if they don't do that, make sure you go ahead and open up a separate bank account so that everything is separate, personal and business. So now let's talk about some property management and administration stuff, which even if that isn't all too fun, it's a necessary evil. And even if you have a property manager, here are some just practical tips that have helped keep me stay in line. So the first thing is to keep a trusty old file folder. And I know what you're probably thinking, Griffin, we're not in the 1980s anymore. Pretty much everything is done electronically. But to my surprise, actually, when you're investing in property, buying properties, selling them, and going to the notary, you end up with a lot of actual physical paper documents, things from actual rent documents that you keep a copy of and then you give a copy to your tenants, things such as location certificates, along with a whole bunch of other things that the bank's going to give you for the mortgage. And having a file folder with a separate section for each property is just going to be really beneficial for you over the long term. I'm personally someone who loses things relatively easily, so just making sure that I have all my files in order in one single place has been a lifesaver. And for $15 most likely on Amazon, I'm assuming this is definitely a no-brainer if you're going to own multiple properties. The next thing I would recommend doing is keeping a spreadsheet of all of your income and expenses. It's one thing to have a separate bank account, which is absolutely necessary, but then also keeping a spreadsheet is going to help you better identify what your expenses and your income is at the end of the year so that you can properly file your taxes and provide that even to your accountant if you do it with an accountant. You need to remember here that this is a business that you're now running, and so it's really important that you keep track of all of your income and every single one of your expenses so that at the end of the year, when you go to claim those expenses, you have proof of what they are and you have a paper trail of them. I personally just use Google Docs for this purpose, and then on top of keeping track of my income monthly and the expenses monthly for each property, I also keep track of the equity that's being built in the property each month from paying down the loan, along with other things such as the return on investment, etc. The next tip might be really obvious to some, but that would be to put important dates in your calendar related to the properties in question. This includes things such as deadlines for submitting rental increases, along with other things that are a bit more administrative, like the dates for filing your taxes and little reminders at the beginning of the month to collect your payments. All right, moving on. This is a concept that I want you to drill into your mind right now, in that every property that you acquire is its own mini business, and then your larger property portfolio is your business as a whole. So with this in mind, every time that you spend anything on the property, you need to make sure that you're properly tracking those expenses so that you can then offset your income at the end of the year. Since every property is its own mini business, well, you can deduct multiple things as a business expense. For example, the interest you're paying on your mortgage, the taxes, property maintenance, repairs, and the list goes on. Another thing to keep in mind is that every time you get into your car and drive over to one of your properties, well, this is business time. You're pretty much on the job here, and you can claim expenses related to your vehicle, things such as, for example, gas, insurance, maintenance, and repairs on a proportionate basis to what you used it for business purposes. So if prior to owning a property, you were an employee and that was your main source of income, well, now you have two sources of income. You have your employment income, but you're also a business owner now. And so you need to get into that business owner mindset where you can deduct certain expenses related to creating that income. And so now that we understand that this is in fact a business, there are a couple other things that I was personally faced with that I want to make sure are very clear for you. First of all, do not spend any money whatsoever on any type of aesthetic repair or repair that does not need to be made right now just because the tenant is asking. Now, of course, if the necessary repair is actually something that's impeding on the quality of life of your tenants, then yeah, of course you need to fix this, and this is your responsibility as the landlord. But if it's purely something aesthetic, which I've been asked multiple times by different tenants to upgrade while they are living there, well, no, you should be avoiding spending any type of money whatsoever on something that's not going to actually impact the value of the property right now while they're living there. And you should really only do these types of repairs once those tenants end up leaving the premises and you're getting it ready for a new tenant. There's a bunch of examples that I could use here from my own personal experience, but here's a quick one. I had a tenant living in one of my units, and essentially there was carpet on the upstairs. Now, they have been living there for about 8 years or whatnot, and they've had a dog for a long time pretty much, and that dog ended up doing their business on some of the carpet, and the tenant was asking me if I could change the carpet while they lived there. Of course, I'm not going to do that. First of all, the reason why the carpet was ruined in the first place was because the dog was doing their business on the carpet, and the dog would still be there if I did those repairs. So no, of course, that is not something that I would spend hundreds of dollars changing while they are still there. Once they do end up leaving, yes, I would go in, change the carpet, get it ready for the next tenant. And also keep in mind here that smaller, less expensive things like new paint, new trim, and even new flooring, some of it is not all that expensive. These can go a long way in the perception of the unit that you have and bringing it back up to a modern standard. Even once the tenants do end up leaving and you're doing some minor cosmetic repairs to get it up to par for the new tenant, I would only recommend doing things that are going to have a direct impact on increasing the rent value per month in the right now for the next tenant, and then also increasing the market value of the property. You don't need to spend ungodly amounts of money updating the property from a more fundamental standpoint if you don't need to. Moving on to the next point, this is by far the most important point that I'm making in today's video, and that is that your tenants are not your friends. Your tenants will remain your tenants, and that's going to stay that way. This is something that you do end up hearing quite a bit in regards to real estate investing, but it could not be more accurate. If there's one thing that I want you to retain from today's video, it is this point right here. Now, I'm not saying that you need to be a stone cold ruthless shark by any means. These are people, and they're also tenants who are living in your property, so their well-being is also to your best interest as a landlord, of course. But this does not necessarily mean that you should be overly friendly with them and sort of lower that professionalism barrier to a point where they could potentially see you as more of a peer, like I was talking about earlier on in the video. And this has happened to me a couple times, especially on the first property that I ended up purchasing. One of the tenants, well, it was two tenants who lived together, and they were on the younger side. Anyways, essentially, I was giving them a bit too much slack at the beginning, giving them the benefit of the doubt, and over and over and over again, they were kind of abusing of that and knowing that the relationship was a bit lower than where I would want it to be from a professional standpoint. And so once that precedent has already been made, it's difficult to go back on that. That ended up being one of the worst relationships that I had with tenants, and is one of the main reasons why I've now set certain criteria for how I personally manage properties, and I try to never stray away from those. For example, having email exclusively, not texting tenants. They would text me nonstop whenever anything ended up happening at the property that did not need any type of immediate attention. It was just kind of impeding on my own personal life, and ultimately is something that I would want everyone watching this to avoid. This has not only happened to me a couple of times with different tenants, it's also happened to a bunch of my actual peers, friends, and real estate investors who also, especially at the beginning, ended up doing sort of the same thing, and it ended up biting them. So across the board, I've seen this as being the type of behavior that you want to avoid at all costs, of treating your tenants sort of as peers or friends instead of really just keeping it a professional relationship. And for those of you who are asking me where I search for tenants, pretty much exclusively Facebook Marketplace is where I've had the most success. In the past, I have listed units on Facebook Marketplace, Kijiji, along with PadMapper, and pretty much 80% of all the applicants come from Facebook Marketplace. So yeah, that's pretty much my main area for where I search for tenants, along with the criteria that I look for. Well, actually, I mentioned the different checks, but things I specifically look for are recurring monthly income from a job. That's typically something I like to see. It doesn't necessarily need to be a job, but as long as the individual is able to show me that they have recurring income from a source, that is usually going to be adequate. And then also the credit check is something that is really important to me to see if they're up to date with their payments and they don't consistently miss out on some of their credit payments. So that pretty much wraps it up for things that I have learned, and then tips that I would want to pass along to anyone watching this as my experience after 2 years of investing in real estate in my early 20s. I really hope that this was of value to you. If you did enjoy it, make sure to smash the like button and let me know down in the comments what are some things that you took out of this video or that you would want me to answer further. Now, if you want to learn more about real estate investing and stock market investing, make sure to subscribe to the channel and hit the bell button to be notified. ahead of my new and upcoming content. And then also, if you're not able to be a property investor right now as a result of some of those elements we spoke about regarding the barrier to entry of real estate, then make sure to check out Addy. It's a really great platform where you can start investing with as little as $1 into property. So I'll leave a link again down in the description for Addy. On that note, thanks a lot for watching today's video, and I will see you all in the next one.